What's up, everyone? Welcome to the 12th episode of the Multifamily Methods Real Estate Podcast. I'm your host, James Gleason. Wanted to talk this week about what we can expect in the future of apartment units, of multifamily properties. There's a lot of talk about what's happening in the residential space, what can be expected. But I don't think people really have a grasp on apartment units and how actually the residential and commercial space correlate. And the future of the multifamily market is actually a lot more predictable than people think. And so I want to get into some of the data, some of the specifics of the multifamily market. For me personally, I'm in Florida this week on vacation with some real estate friends and having a really good time here and closing on some smaller deals. I closed on a quadplex last week. I will be closing on a single family house next week. And so really still, dabbling in the smaller deals. I'm not really looking to purchase anything extravagant this year. Really just still focusing on, refining my systems, setting up my systems and processes. And so that has been great this year. It's been going really, really well. And so I'm excited about that. So when we look at the multifamily market, I own quite a few, apartment buildings. And if you're watching this, you do not have to purchase apartment buildings with syndications. So for those who don't know, a syndication is pooling several investors' money together into one pot and then investing that money into an apartment deal. And traditionally, this is done with general partners and limited partners, GPs and LPs. And the advantage of a syndication is that if you want to raise money and you are a GP, if an LP has an opinion on the deal, if they want to sell, refinance, if they want to operate the deal a certain way, they do not have a say in the operations of that deal as the limited partner. And so it really takes out a lot of the risk from an operational perspective in trying to make your partners happy. If you are the subject matter expert and you don't want your partners to get in the way of how you're operating that deal, a syndication has its advantages in that an LP cannot stick its nose in the operations or how he or she thinks the deal should be operated. And so that's one advantage. A disadvantage is, typically, and you don't have to do it this way. You could be the only GP in the deal and still have a lot of equity. But traditionally, how these syndications work is you have, 3+ general partners and then as many limited partners really as it takes to make the deal happen. And so if you have, let's call it 3 GPs, maybe one is responsible for construction management, one's responsible for asset management, maybe the other person's responsible for the finances. And that's traditionally how it works, by the way. You have your GPs that do all of the work, and you have your LPs that basically raise the money, and then they're completely passive at that point. And so a typical split with syndications is a 70-30 split. You'll also see 80-20 splits. In some cases, you'll see 60-40 splits, but the majority of the time, you're going to see a 70-30 split. 70% of the equity going to the limited partners, and then 30% of that equity going to the general partners. And so when you really break down the math, if the GPs are getting 30% of the deal, and there's 3 GPs, and in some cases there's more than that, then each GP is really getting 10% of the deal. And so someone can syndicate and say that they own 1,000 units, and it sounds great. And I have a lot of respect for those people, by the way. I'm not taking anything from them. But in reality, when you break down their equity, they own 10% of 1,000 units, which is the equivalent of owning 100 units by yourself, right? Which, again, anyone who owns 100 units, that is a feat to be very proud of. I mean, that takes a lot of work, takes a lot of operational expertise, ability to find deals, all of these things, right? And so I have a lot of respect for these people, but a syndicator who owns 1,000 units is not the same thing as, a sole proprietor or just an investor who owns 1,000 units on his own. And so those are very different things. And so I've seen a lot of syndications as sort of a vanity play. How many units can I say that I own? And for some that's true, and for some that's not true. There's other syndicators who really like the idea of larger investments because operationally it could be more efficient. You could have on-site property management, people who are actually working at the apartment complex. You get economies of scale, so you can get discounts for buying things in bulk and for doing things in bulk. And so there are advantages to a syndication play, but in a lot of cases, syndicators are just saying they own a bunch of units, but when you look at their balance sheet, it's not as impressive as it seems. I would rather own, a vast majority of my portfolio and have more equity and cash flow in those deals than to just say I own a bunch of units. Owning a bunch of units is not ultimately going to help my lifestyle, my financial health, etc. Right? So that is so I invest primarily utilizing partnerships or the Burr method or creative finance. Actually, in a lot of the same ways that I invest in smaller residential deals. I might buy an apartment complex at 70% of ARV, 75% of ARV, in the same way that I buy a single family home at 75% of ARV. And then, I'm purchasing this asset, increasing the value by, renovations and forced appreciation and increasing those rents. And then I'm refinancing at 75% to pay back that original note. And so I treat apartments in a lot of the same way that, I treat single family homes and small multifamily. Because again, if I can increase that value and have 25% equity in this deal, I can really quantum leap my net worth through equity in, multiple apartment complexes. So that's how I've approached the apartment game. I've gone, I've either done a 50-50 partnership. I've done seller finance, seller carrybacks, where, I'm putting up a down payment. The seller is carrying back a percentage of the down payment on the backside. And so I don't have to come to closing with as much money because that seller is carrying back and paying me that money back at closing. And so that's allowed me to purchase more deals with less money down. I've done a master lease option, which is essentially where I'm taking over the management, taking over the operations. I'm collecting 100% of the rents. I'm paying the expenses. I'm paying the mortgage. It is as if I own the deal, but the deed is not in my name. And then the idea is over a course of 3 years or however many years you negotiate the term, you increase the rents and thus increase the value of that asset. And then when you purchase that deal, you now have a bunch of equity, and then you could refinance later on to pay back that money or just have a bunch of equity. And so I've also just done partnerships, 50-50 splits, and then we're increasing the value together. So I've approached apartments in a lot of the same way that I've approached these smaller deals and these single families, because I believe I can have more equity and more just success as an investor approaching it. I can't speak today. Approaching it that way rather than approaching it like a syndication. But I want to get into the data of multifamily apartments and what we can expect in the future, because 2025 and early 2026 have been very difficult years for the vast majority of multifamily investors. Interest rates are higher, and it seems like all costs are increasing except for rents. You have more expensive taxes, you have more expensive insurance, mortgage payments are higher, labor is more expensive, everything's more expensive. And the only thing that can't really seem to keep up are the rents, because the average American is already struggling so much with affordability. And so, especially for those investors who, invested in these deals with 3% interest rates, and then, if they had to refinance in 2026, let's say they purchase a deal in 2021 at a 3% rate, and they have a 5-year balloon, which turns out in 2026, and now they have a 6 or a 7% interest rate, that cap rate is now much higher, and they might struggle to refinance out of that deal. So that's been a nightmare for a lot of people. I've talked about that in length in previous podcast episodes. But even for people who are not getting in trouble with the refinances, like myself, we are still, as investors, we are struggling because those rents just can't keep up with those increasing costs. And so, what is likely to happen over the next 2 or 3 years in real estate? Well, the data says that multifamily real estate is going to do very well over the next 2 or 3 years. And this is not wishful thinking. This is not speculative. This is all coming from data. So the best way to predict pricing in multifamily, sales prices and rental prices, is supply and demand, just like any other sector of the economy. And so if there are more housing units that are developed, supply will increase and prices will come down. And if there's less supply and less development, the inverse is true. So there will be less supply, and so prices will increase. And what you saw, during the COVID era was a decrease in interest rates, and thus a spike in the amount of permits that were being pulled for new development. And, this is obviously very incentivizing for developers when you have very low interest rates, because they can now develop their multifamily apartments and commercial units for much cheaper. It costs a lot less to borrow that money, and therefore they can build more apartments. But as we all know, in 2022, we saw a spike in interest rates. And when we saw that spike in interest rates, and interest rates went up very, very quickly, you saw a very sharp decrease in the amount of permits that were pulled for new apartment units. And there's typically roughly a 3-year lag from the time those permits are pulled to the time that those apartments are actually completely developed and listed on the market for rent. And so you saw a very sharp decrease 2022, 2023, 2024, and 2025 because interest rates have been higher. So you don't have nearly as many permits that are pulled, and therefore you don't have nearly as many new apartment units that are going to be developed over 2027, 2028, and so on. And so the idea is, since there is significantly less supply that's going to be on the market, tenants are going to have less options in terms of where they live. And so with that, rental prices are very likely to increase in 2027 and 2028 as that supply continues to be staggered and not increased. And in real estate, you really have an inverse effect with interest rates. And so if interest rates remain high, you will continue to not see developers develop. And so rental prices will continue to increase as that supply continues to stay low. On the other hand, if we start to see a decrease in interest rates, then you are going to see investors with more purchasing power, more gunpowder, and therefore prices are likely to increase. And so you're either going to see rents increase or prices increase. And it's more likely in the apartment space that you're going to start to see rental prices increase in 2027 and 2028 because of these high interest rates and because of this likely sharp decrease in the supply of multifamily housing. So that's one metric that I have been paying attention to, and that is quite exciting for multifamily. There's really two more charts that I want to talk about, and I'm not going to share my screen. I'm not going to really go into this massive detail. You guys can Google this information. You can do your research on this information that I'm talking about. But the next chart that I looked at was the stock market price relative to real estate and the returns that those gain. Real estate tends to slightly outpace inflation over the past 100 years. And so, those two metrics, you see the stock market slightly higher than real estate, but they mainly keep pace over time. And what you are seeing right now is that the stock market is 40% higher than those real estate prices compared to historical data. And so the idea is, either you're going to see a stock market crash or you're going to see real estate prices go up over time. Keep in mind, guys, when I'm talking about this, real estate is local. And so most of the people listening to this are going to be in St. Louis. That real estate is going to react differently than if you're in, obviously California, New York, somewhere on the coast, Florida, Texas. Depending on what market you're in, real estate is going to react differently. So what I'm talking about today is really from a national perspective, right? Just from a high level, how is real estate going to react? So that is a chart that was quite exciting. And then the last chart that I want to talk about is, upticks and downturns in the real estate market, and how you typically see 1 to 2 years of a real estate downturn followed by 15 years of prosperity in the real estate market. And so, for example, we saw this in 2008, 2009, where, we saw a downturn in real estate prices followed by, 15 years of, increasing real estate prices. And then, 2024, 2025, you saw a decrease in real estate prices in most parts of the country. And so the idea is, likely, if history is going to repeat itself, we will see another 15 years of prosperity in the multifamily markets. And so that chart is also quite promising. And so all of this data, you kind of look at all of these charts, and all of these things are sort of happening at the same time. And so what I think is going to happen is you have a lot of multifamily investors right now who are struggling. And the tempting thing in 2026 is going to be to sell your real estate, because you're probably not seeing nearly as much cash flow as you're used to seeing in your real estate. And so most people are going to be like, this is not worth it. This is not why I got into real estate. And so I am going to sell. But just like in most parts of real estate, I think the people who can hold on through this cycle, and this has been a really bad cycle for a lot of people nationally, depending on where you're listening to this from. But for those people who can really hold on to this real estate, and despite the negative cash flow or the break-even cash flow, just hold on to those properties. I think that those investors over the next 2 to 3 years are going to do very, very well with their investments. I think probably it makes sense to do the inverse what most people are doing. So right now, interest rates are high. It's higher to make the numbers work with real estate. And so most investors are either sitting on the sidelines or trying to sell their real estate as the numbers in their real estate continues to not make sense. I actually think you should be doing the opposite right now. Now is a better time to buy real estate if you can make those numbers pencil out, because it's harder to make those numbers pencil out, and therefore there is less competition. And so if you can make those numbers pencil out and you could purchase that real estate despite the high interest rates, you are going to be able to find better deals than, let's say, 5 years ago during the COVID era, when there was so much competition and it was so hard to make the numbers pencil out. So now is actually the better time to buy real estate. Then if we start to see a decrease in interest rates, this is going to be the time when most people are purchasing real estate, because it's easier to make the numbers pencil out, etc., for the same reasons, right? And so you're going to see a lot of investors in the market that are now ready to purchase real estate, because when they underwrite the deals, the numbers make sense. Well, I'm going to tell you, if you're going to sell real estate, obviously there's arguments to hold on to real estate forever, essentially. But if you are going to ultimately sell your real estate, when those interest rates tick down, that is going to be the better time to sell your real estate, because now your buyers are going to have more purchasing power, more gunpowder to actually be able to purchase your real estate. And so you're going to get more money for your real estate. And so that's kind of my base case. If I can hold on to this real estate for the next 2 or so years, the market nationally, right, is only going to get better with multifamily apartments. And so I would rather not sell right now if I don't have to. Obviously, it's quite difficult with some properties. We do have some properties that are struggling more so from a cash flow perspective than they have in the past, and so that obviously makes it difficult. But I also know what's coming because I've looked at this data, right? And guys, if there's any such thing as a crystal ball in multifamily real estate, this is it, because the amount of permits that are pulled is directly correlated to the amount of housing units that are available. And multifamily real estate, just like any other sector in the economy, relies on supply and demand. Obviously, interest rates have a lot to do with demand. Employment, population growth, all these things have to do with demand. But the supply side of the equation is also very, very important. If you have less competition, prices are going to increase. And, it's interesting. Rental prices shot up quite a bit, obviously during the COVID era and a few years ago. But they've really remained stagnant in 2025, early 2026. And in certain parts of the country, rents have actually gone down a little bit. My rents haven't really decreased in St. Louis. So I'm fortunate about that. But you do have some investors who are seeing a decrease in rental prices, and all of their other costs are going up. And so it is becoming more and more difficult for these people to make sense of holding on to the real estate. So if that's you and you're listening to this podcast, I hope that this episode gave you a little bit of hope in the real estate that you're holding on to. And remember, guys, real estate long term, 99 times out of 100 is going to be a good investment. Even if you're not getting this crazy appreciation, all the tax benefits that you're getting, the principal pay down that you're getting over time,